Tulip Mania, a speculative frenzy over tulip bulbs, took place in 17th century Holland. The mania began in 1634 after it was discovered that tulip bulbs could be grown faster, and prices reached extreme levels. When a Dutch tulip bulb once fetched a price equivalent to 10 times the annual income of a skilled craftsworker, it wasn't just the flower enthusiasts who were perplexed. It was a clear moment of mass delusion in economic history. It was reported that at the height of the mania, one tulip bulb was exchanged for a factory. Fast forward to the 21st century and we see not flowers but digital currencies creating similar frenzies. Or are they? Could crypto make it all different this time? The question looms, how do seemingly rational beings get caught up repeatedly in such irrational exuberances? And when will it happen again? From the bursting of the tulip bubble in the 17th century to the volatile surges and stumbles of Bitcoin, the patterns of human behavior in economic bubbles have remained startlingly consistent. In this essay, entitled Bubble Trouble, From Tulips to Bitcoin, we shall navigate through the fascinating world of economic bubbles, drawing striking parallels between historical financial manias and the wave of cryptocurrencies.
Bubbles, though unique in their specifics, follow a remarkably similar pattern. A new market or product arrives, public interest spikes, prices soar driven by speculative investment, violent ups and downs in price excite the public, and finally the bubble bursts. The South Sea bubble provides a textbook case. Initiated in the early 18th century, the South Sea Company was promised monopoly rights by the British government for all trade in the South Seas. Investors, enticed by visions of vast wealth, drove stock prices to astronomical heights before reality set in and the market collapsed. This frenzy wasn't just a financial hallucination, it was an orchestrated belief system that the South Sea would bring boundless wealth. The demise of the company not only led to financial ruin for many involved, but also had repercussions on the British economy. This episode teaches us how governmental endorsements and perhaps governmental opposition can amplify a bubble's intensity, a lesson eerily relevant in today's technology-driven markets. The Dutch tulip mania, often considered the first recorded speculative bubble, regularly saw single tulip bulbs traded for sums that could purchase a house. The social status associated with owning rare bulbs pushed the prices to ridiculous levels, revealing the impact of social dynamics in economic bubbles. The mania fizzled out as quickly as it emerged, leading to a painful financial hangover for the Dutch economy. Along the way, no doubt, astute bulb traders made a fortune selling bulbs and buying houses and factory buildings.
Human psychology plays a pivotal role in the formation and bursting of economic bubbles. Two psychological phenomena, FOMO, fear of missing out, and herd mentality, are particularly influential. FOMO isn't a new age concept. It has been around as long as opportunities have been perceived as scarce. Whether it's a piece of the new world in the South Sea bubble or a digital token in the crypto craze, the fear of being left out can drive individuals to make irrational financial decisions. Herd mentality complements FOMO. When people start seeing their peers, family, or colleagues investing in something, the social proof becomes compelling. They jump onto the bandwagon, often disregarding the fundamental value of the investment. This chain reaction can inflate prices and magnify the bubble. The dot-com bubble of the late 1990s is a modern example of these dynamics at play, where the mere presence of .com in a company's name was often enough to ensure a successful IPO. Herd behavior and FOMO weave together an investor's personal fear of losing out and the broader social confirmation, creating a potent mix that can drive an asset's value sky high, far beyond its intrinsic worth.
Today's economic bubble narrative would be incomplete without discussing cryptocurrency. Launched in 2009, Bitcoin heralded a new era of digital currencies. As blockchain technology gained popularity, more cryptocurrencies entered the market, and the public sentiment swung from curiosity to feverish investment. An early peak of this mania was seen in December 2017, when Bitcoin's price neared $20,000, only to plummet dramatically within the next year. Speculators, driven by the modern-day equivalent of tulip mania, FOMO, propelled these valuations. The volatility attracted investors looking for quick gains, reminiscent of the day traders during the dot-com bubble. As of April 2024, Bitcoin set new high prices over $70,000 before retracing to lesser values. Yet beneath the speculative surface, cryptocurrencies harbor the power to redefine transactions and reshape global finance, a potential yet to be fully realized as the technology continues to evolve. The fascinating question as of this date with whether cryptocurrency and Bitcoin in particular are so entirely new and innovative as to nullify human nature, or whether the bubble phenomenon will repeat. How high, how long, how many, no one knows. Will it be different this time? The aftermath of any economic bubble is typically painful.
Those who entered late, often the general public lured by rising prices and media hype, are the ones who suffer the most when the bubble bursts.
The loss of wealth impacts consumer confidence and spending, leading to broader economic repercussions.
As historical and modern examples demonstrate, while the asset classes differ, tulips, stocks, or digital coins, the consequences of bubbles are dramatically similar.
The key lesson remains: investment grounded in fundamentals rather than flock-driven euphoria is imperative.
Recognizing when irrational exuberance overtakes rational decision-making can save one from financial despair and highlights the enduring value of prudence in investment. So if you play the game, be very careful and manage your money wisely.
In conclusion, from tulips to Bitcoin, the colorful yet dangerous dance of economic bubbles continues. Understanding their anatomy and psychological underpinnings can equip us to better navigate these treacherous waters and perhaps, just perhaps, temper the inevitable next bubble. Bitcoin has made some very rich people in the past decade. It may do the same thing again, or it may become a decentralized world currency, defying world governments' needs to control their people and economies. What do you think the future holds? Vast riches for all, or folly, or both?